Hello, welcome back. So in today's video, I'll be talking about why expensive stocks can look cheap, as well as whether or not LVMH stock is a buy today. So in today's video, I'll be covering a few things. We'll be covering why expensive stocks can look cheap, LVMH stock, as well as some questions that you guys have left me in the comment section below. So let's talk about why expensive stocks can look cheap first. And this is what Bill Ackman said in his recent interview.
Anytime soon.
That's right.
And sometimes you don't buy what cheap. You think it's a good value, but it doesn't look cheap. Chipotle.
Yeah, so Chipotle didn't look cheap. People use kind of a rubric for valuing businesses, right? The PE ratio. It's kind of a very simple way to think about a business, but a stock can be expensive at 10 times earnings, and it can be cheap at 50 times earnings. What matters is not next year's earnings. What matters is the present value of the cash over the life of the business. At the time we bought Chipotle, they had a food safety crisis. Sales were getting crushed. People thought the company was going out of business, and it didn't look cheap. But if you believed you could change the course of Chipotle's history, fix the food safety issues, it was extremely cheap. And the stock is up, probably ninefold from the time we bought it.
It's amazing. Chipotle is now going into Mexico. Everyone sort of assumed it was from Mexico, but anyway, bad images.
Yes.
So this is how you should think about your PE ratios. So for a PE ratio, there is something called a justified PE ratio. It's basically calculated from your ROIC as well as your growth rate of your company. So when a company has high ROIC as well as high growth rate, it deserves a higher multiple. So as you can see over here, if the ROIC minus the cost of capital spread is around 10% and the company grows at 8%, the justified PE ratio is actually around a 40 times earnings. So an expensive stock with a high PE ratio can actually look cheap relative to the justified PE ratio. And beyond that, a company that trades at a 50 times earnings can be cheap, whereas a company trading at 10 times earnings could be expensive. Because if the company that trades at a 50 times earnings can grow earnings at a fast rate, the P ratio will contract in the future. But for the company that is trading at 10 times earnings, if the earnings go into the negative territory next year, if the earnings start to drop, then your P ratio will actually expand. So this company that is now at 10 times earnings could be at 15 times earnings in a few years' time, making it a lot expensive than what it is today. So as Bill Ackman said earlier as well, you want to pick stocks that can grow in the future as well, because if there isn't a growth element to the business, or if you cannot predict to a high level of certainty that a company can grow in the near future, then the present value of all the free cash flows in the future will be low, whereas another company that is able to grow quickly will be able to have a high intrinsic value as well. So this is Chipotle. So Bill Ackman actually bought the stock at 137 times earnings when the company was undergoing some form of food crisis, and he was confident that the company can turn it around because it was on a downturn. So this is an example of a company that was trading at an elevated valuation that looks a lot cheaper at today's price. So another company is Amazon. So Amazon in 2022 actually had negative earnings, and in 2023 the stock traded at a 245 times earnings. So if you have to look back at what happened in 2022, basically Amazon pumped in a lot of their money into R&D expenses. So if you have to look at this line over here, which is technology and content, basically Amazon's R&D cost, Amazon's R&D cost went up by 20 billion, close to around 20 billion in just 1 year alone, and that hurt their operating income that year. Because if you were to just normalize the R&D expenses to a similar growth rate as what we saw in 2021, then the company would have been net income positive. But in that year, they increased their R&D cost by quite a large margin in terms of percentage and nominal terms, and that's why the company went into negative net income territory. But for a company like Amazon, it was investing into R&D to have future expected growth, and that's why although the company was trading at an extremely high PE ratio in 2022 as well as 2023, the stock was actually cheap at that point as well, because there will be a lot of growth in the future as a result of the R&D costs that the company is bearing at that time as well. So when it comes to buying a stock, buy a company with the ability to defend its share and grow above its own industry, because amazing companies will look expensive on surface, but over time it will get cheap as well. So Amazon as well as Chipotle, they were momentarily expensive, and on hindsight they looked very cheap back then despite the high valuation as well. Next portion that I'll be talking about is whether or not LVMH stock is a buy. So I think the company is approaching buy territory soon. So LVMH has amazing scale, it has amazing brand names over here. So you have companies like Givenchy, you have Loro Piana, you have Fendi, Tiffany & Co, Dior, Bulgari as well. All these different businesses under this one big company, which is LVMH. And for LVMH, they have amazing heritage as well that no one can replace or no one can replicate. So LVMH, the brand itself, actually came about in 1837. Dior as well came up in 1946. So for LVMH, they have pricing power as well. So this LVMH Speedy bag has grown at a compound annual growth rate of around 5% since 1979 up till 2020. Same thing for their Dior bag as well, which has grown at around 10% in recent years. So LVMH on top of volume growth has been able to enact pricing power as well. So they're able to increase prices at levels above the rate of inflation to increase the revenue and the profits of the company as well. So LVMH is like a mini Berkshire because of their sheer size. They can't grow too fast because it will dilute their brand. So for all your luxury brands, they will want to try and promote scarcity, and that's why you can't increase the volumes at such a high rate, which will affect their brand value. So that's why all these companies, they can't grow volumes at 10-15% because they don't want to hurt their own brand. And for LVMH, they do something similar to Berkshire. They take capital from slower growing businesses and then they pump it into new businesses as well as acquisitions. So it is unlikely that this company can grow at 20-30%, but it is a highly predictable and stable business. Your luxury market last year was down around 2% globally, but LVMH was up around 1% on a constant currency basis as well. So this clearly shows that LVMH has resilience and it is one of the high quality luxury companies in the entire sector. That's why it's the second largest luxury company in today's world. So for Bernard Arnault as well, he has amazing capital allocation skills. So he bought Dior in 2017, he bought Tiffany & Co. in 2019 to 2021. The deal was finalized in 2019 and then they bought it over in 2021. So for Dior, they bought it at $13 billion. And so far the yearly ROI from Dior itself is around a 25-30%. So it is highly likely that they already made back the money that they invested into Dior, and Dior now makes up a substantial portion of their leather and goods portion of the business. As for Tiffany & Co., it is not as good as Dior, but it has been able to achieve around a 10% annualized return, and LVMH is currently up there in your jewelry section as well. So for LVMH, they're starting to increase their global presence as well. So they signed a deal with F1 recently, a 10-year agreement from 2024 up to 2034 to basically have LVMH sponsor the F1 itself. As for LVMH, there is also the insurance side of the business, basically the real estate that they own. So if you didn't know, LVMH actually owns a lot of the properties that they sell their products in. And this can be seen as sort of like an insurance for the company that you're buying today. So they have around $60 billion in real estate on that $260 billion market cap. So that could be a flaw for LVMH in terms of its stock price, because the company has hard assets that it owns as well. So for LVMH, the main headwind that I'm seeing for the business today is simply just the China consumer spending. So you're seeing all these Chinese TikTok accounts mocking LVMH, and this is overall bad for the business as well, because the Chinese consumers, they have stopped spending money on luxury, especially in China, and that's a major headwind for China as well as LVMH. So China makes up around 30% of their revenue. China, as in the Asia portion, makes up around 30%. And China's luxury market is actually declining with a potential shift away from luxury to more local brands. So you're seeing more of the locals supporting their own local brands like Anta, Li-Ning, and so on. But I live in a pretty Chinese dense area, and so far I see this as a short-term headwind for the business. Because from what I've observed, I'm still seeing a lot of Chinese internationals coming into Singapore and buying the LVMH products as well. So your luxury growth is projected to be around 6% all the way until 2030, and I expect LVMH to grow in line with this or slightly above this as well. So for LVMH, this is my valuation for the business. Assuming an 8% EPS growth for the company and assuming a 20 times earnings, this company has historically traded at between a 26 to a 27 times earnings. So 20 times earnings is quite a conservative price relative to its history. So assuming a 20 times earnings for this company at its current price today of 461 euros, this company will give you around a 12% annualized return. So it is currently slightly undervalued, and I did a DCF calculation for LVMH as well. So assuming an 8% free cash flow growth for the first 5 years, and then a 5% growth for the next 5 years, this company is currently trading at a fair value of around $531 a share. And that is around a 10% margin of safety from today's price. So LVMH at today's price is hovering between fair value and slightly undervalued on these conservative estimates over here. And for LVMH, the company is extremely durable. It's at a decent valuation now, but I'm hoping for more of a margin of safety, especially because it is tied to your consumer. So retail businesses are typically bad businesses, but for LVMH, it's slightly different because of the brand power itself. The company is stable, it's a predictable business, probably won't be a crazy market beater, it won't beat the market to a very large extent, but it'll be one that will trickle along and do slightly better than the market as long as it's at a cheap price. So LVMH at today's price at an 18 times earnings, I see it as a decent opportunity. I'm hoping for more downside so that I can add it with a larger margin of safety. Last portion, I'll be talking about some questions that you guys have left me in the comment section below. So the first one, it says, what is your fair value to get in for Amazon? And for me, I think Amazon at today's price is around fair value also. So my fair value for Amazon is at around $200 a share. I think the company is one of the best Mac 7 companies out there, one of the most predictable ones as well. And for macroeconomic conditions, all these business cycles, they will come and go. and that will not structurally impact Amazon as well. So in the long term, if you're to just discount all these macroeconomic conditions, I think Amazon is one of the highest quality businesses out there. So for Amazon at today's price, I think if you're to buy into the stock today, it will likely give you market beating returns. But of course, for a company that is fundamentally cyclical like Amazon, maybe you want a margin of safety. So around $190 to $180 a share could be a good price for you to enter into Amazon. But I think at today's price, it is around fair value as well. So I don't see any problem with adding at today's price. Next question it says, thank you for the answer to my last question. Pool Corp is at a low price. Is it a good time to add in? So for Pool Corp, it is a company that is quite monopolistic. It is a company that Warren Buffett clearly likes. But for the business itself, I think the company is still trading at quite a high valuation. So if you're to just look at the P ratio itself, the company is trading at 27 times earnings. But yes, there's a lot of headwinds that is facing this business right now that could potentially turn into tailwinds as well. So the company could be earning depressed earnings, meaning to say it is earning a lot lesser than what it is supposed to earn, simply because of the headwinds that is facing this business right now. But for Pool Corp, I'm still reading it up. I think it is a high quality business. But for me, I would like a larger margin of safety as well, similar to LVMH, similar to Amazon as well, for me to want to enter into all these stocks. I think for retail businesses like Pool Corp and LVMH, I want a larger margin of safety, and so I don't think I'll be adding at today's price. Hopefully it drops a lot more so that it comes to a price where I'm comfortable adding it at. But at current prices today, I think LVMH is providing a much better opportunity as compared to Pool Corp. I hope you guys have found this one useful and invest safe.